For more on today's release of the FOMC March meeting minutes, let's bring in Cathy Zhang, who is the Purdue University Associate Professor of Economics. Cathy, great to have you here with us today. As Brian was mentioning, the Fed taking the punch bowl away. How quickly might they swipe it? And quite frankly, how are the markets going to continue to react?
So it's great to be here. And this has really been kind of a change in the Fed's history of easy money. So two big pieces of news from the meeting release. As Brian mentioned, the interest rate hikes of 25 to 50 basis points was more or less what a lot of people expected, but also more detailed plans on this quantitative tightening, which is the exact opposite of what happened in the last few years, through the series of gradual balance sheet normalizations, through the limits on the treasury securities and mortgage-backed securities. So I think both these policies are jointly designed to fight inflation. And I think this will have a lot to depend on how the current situation in Ukraine unsettles and stabilizes over time. And certainly the markets are going to react. And I think the markets are going to stabilize as inflation gets to more normal levels.
And so for the Fed, if they are going to continue to be perhaps fast and furious, yet at the same time data dependent, at what point do you believe that if there was some type of reactionary data that had showed up because of the decisions that they were making, showing up in economic data, of course, here, as they're evaluating that, at what point do you believe that they would either slow down or pause?
So I think that's a really tough question to answer for the Fed, because they want to achieve, I guess, two goals with the meeting releases. First is to provide transparency on their policies and what they're currently doing. But second is to set expectations regarding what the future is going to look like. And so I think in the current meeting releases, this is providing more background on just how exactly they'll try to enact this quantitative tightening episode. And, I think going forward, it's going to kind of be tough to forecast how the markets exactly are going to react to the interest rate increases and the quantitative normalizations.
Certainly. Anytime we have such a long stretch as we did of accommodative money policies, any move back to tightening or any move back towards what companies are also going to have to grapple with, everything from the tech sector has been reacting all the way into, of course, the financial sector as well. How more largely does this impact the broader state of the economic recovery, if you will, when we're looking across not just rates, but the tightening of their balance sheet?
So I think, Fed implications have huge effects across different sectors. And the ones that you named are like the key ones that we're paying attention to. Certainly the events in Ukraine have put kind of the attention on oil prices, substitutes. And we've seen in the markets that even though oil prices seem to react quite strongly, they're now stabilizing a bit more. So I think, as the situation unfolds, the markets are going to continue stabilizing. That's at least what I hope to see.
Certainly. And then additionally here, as we're taking a look at oil, and we're going to get more into oil over the course of the rest of our show today, with regard to that, the Fed's goals of price stability also came up in the last meeting as well. At what point do you believe we will still achieve that price stability that the Fed is trying to march towards, especially knowing the impacts of oil on some of those other prices that we are paying, not just at the pump, but elsewhere in our own consumption patterns?
I think the Fed's objective is to normalize inflation to more typical levels around the 2% inflation target. And currently we're like over 3 times that target. So this is a kind of a big change in Fed's policy from the emphasis previously on unemployment and economic growth. Now the tables have turned a bit and we're trying to not overheat the economy too much, And the emphasis here is on stabilizing inflation. So I think in the next few years, inflation should stabilize. But the tricky thing is, all of these policy measures take time for the economic effects to be actually felt and observed in the real-time data. So it could, even though the Fed wants to stabilize inflation immediately, the effects maybe we won't see them until a few months.
Certainly. Cathy Zhang, who is the Purdue University Associate Professor of Economics. Thank you so much for taking the time and breaking this all down to